Alright guys, so I want to talk about in this video, let me put the lights on actually, that's better. I want to talk about in this video what not to do in crypto. And for this one, it's a big mistake that people make. And I want to have a little bit of a nuanced answer here before I get into this topic. And the nuance is that this concept of gaining conviction with higher prices is only really relevant to the long-term investors, which is what pretty much all of you guys are going to be doing. Like with investing, with making money in crypto, the thing that everyone does is long-term investing, and then anything you do outside of that is like an addition on top of it, right? We all do the long-term hold, and if you do any of the swing trading or the day trading, airdrop farming, yield farming, NFT flipping, any of the other shit, pre-sales, you know, it's all on top of the long-term investing. And what I want to talk about is the real fundamentals of investing. I don't really want to get too much into the nitty-gritty, like how to day trade and swing trade, because I honestly don't even recommend that stuff. I don't day trade, and I wouldn't teach you how to day trade. I don't swing trade. I don't do momentum trading. I would never want to teach you that stuff. I just focus in this course on teaching you what I'm an expert in, or at least feel like what I'm the best, most qualified to speak on. And if you want to learn about this other shit, then you can learn it from other people, right? So let's get into, now that we've done the nuance, why gaining conviction with higher prices is bad. So as the price of an asset rises, the upside becomes less asymmetric. And asymmetric upside is the only way that you can make sure that you make money in the long term. Because let me show you, like, this is like a little bit of a fake chart, right? The idea is you want to buy in a low enough price region where the downside potential is not much, but the upside is a lot. Because if you buy after the price has gone up, there is a lot of people in a profit, and price has a higher probability of going down because the price moves in the direction which fucks over the most amount of people. So if the price has gone up quite a bit, a lot of people are in profit, they're pretty happy. The path of least resistance is getting more and more likely to be going down because all these people are now in a profit because the price has gone up. So when you buy at the point where the path of max pain is up, you are buying where there is the least downside risk and the highest asymmetric, return profile. And the later that you leave getting the entry, the less asymmetric, because there is a higher probability that price is just going to crash down to, fuck over all of those people who are now in a profit, right? So that's sort of how markets work, to give you a bit of a breakdown. So your goal is to buy the bottom, or near the bottom, when it's asymmetric, and then not be looking to buy up here. But the problem with you guys is that you don't do this. Like, the goal is your interest in buying should decrease as the coin goes higher. The higher the coin goes, you should be less interested in buying. You shouldn't. If something goes 3x, you shouldn't even be trying to buy it. Like, you should have already got your core position filled at the bottom because you weren't being a pussy, doing a small position when it hurt. You should have gone all in really hard when it was the right time to buy. And you shouldn't be increasing the level of risk that you have in your portfolio as the bull market goes on. And this is one of the biggest problems people have in the bull run. This is a thing that you don't want to do, which is a sort of, related to what we're talking about here. There's always a mess on these charts, isn't there? Yeah. So one of the biggest risks, and I've seen this with some of the guys that I'm helping with investing, and I'm having to get them to avoid this, as the bull market is going on, right? We are, in this bull run, right? We're maybe halfway through it potentially, right? Halfway through this one. What they do is they get to like this point, right? And they start, and even up here and up here, and they keep adding more money into the market because they're making money, right? So they're thinking to themselves, oh, well, I'm making money, so I'm good at this, so maybe I should add more money in so that I can make even more profit because I'm just such a good investor that it's just worth the risk. But the thing is, as the bull run gets later and later, as you get up to these levels, you should be reducing your risk. You shouldn't be increasing the risk. Because the reason you're making all the money is because you entered when the upside was asymmetric. But when the upside is no longer asymmetric, any further capital you add is increasing the cost basis of your overall portfolio, right? So let's say that you entered all your positions here, which would have been a very logical entry, right? Your cost basis is here. Now, let's say the bull run's going on, you're adding here, now you're adding here, now you're adding here, and also here, you're adding here, and now you're adding more over here. Your cost basis goes from this level up to here, maybe up to here, maybe it even goes as high as this level. And then what ends up happening is now that your average entry is here, it doesn't matter that you bought the bottom because you also bought the top. And then when the price goes into a bear market, you never took profits properly because you've just been adding continually money into the market. You end up fucking being in a loss. You got in early, but now you're in a loss. So the goal is that with all your money, you buy it in near the bottom or at the bottom when the upside is asymmetric. And then as the bull run goes on, you're not trying to add more money in, you're taking money out. You should be selling and taking it out, never putting it back in as we get up to these levels, right? Because the upside is not as asymmetric. There's a lot of downside risk. Think about all the fuckers in profit right now, right? We went to an all-time high. Every single person's in a profit. Where do you think the path of max pain is, right? Once we get up to these levels, the path of max pain is down, and then it's up, and then it's down. We've got to take all these people's profit, right? So that's just how markets work. So that's why you can't be gaining conviction as prices go up. Now, let's read the rest of this. But for most people, they gain interest in buying only after the asset has gone up and their Twitter feed is talking about it. They groupthink herd mentality that because their Twitter feed all thinks a coin is good, as the price has risen, that it is worth buying. But you only make money long term by buying without being influenced by the price rising and without requiring a positive consensus around the coin on social media. If you want to make money as a long-term investor, you have to buy when it hurts and you have to sell when it hurts. And I talk about this here. Buying when it feels right to buy is buying the asset at a premium. So it felt really good to buy here, and you pay a premium in the form of the price for that added comfort, right? You pay a premium for the feeling of comfort, for the feeling of safety. But there is nothing comfortable about buying when it feels good. Buying fear is scary up front and peaceful later. Buying greed is easy up front and scary later. So when you buy, let's say in this region, when it's really, really scary, the fear is up front. Once you've bought, the fear is, done. Maybe the first few weeks it's painful, but then the price goes up, boom, now you're in a profit. Now you're chilling. But let's say you buy now, as it's getting comfortable, maybe we have a big retracement. Or maybe you're buying more so in this region, then we have a big retracement down here, let's say after the ETF is approved. Then you're buying when it feels easy, and it's scary later, right? Because there's two pains in crypto, and I think I talk about this in one of the other videos. There's either the pain of buying when it hurts or the pain of buying when it feels good and you lose money. There's only two realities of crypto. But again, I want to add the caveat, the added nuance here. So if you're watching this and your main focus is momentum trading, day trading, swing trading, anything with a shorter time horizon, the above logic doesn't really apply to you. Because the goal of what I'm teaching here is long-term investing, and the goal is to buy when it hurts and sell when it hurts. That's how you make money as a long-term investor. The most important thing is the psychological game. It's the sentiment analysis. That is one of the most important components of investing. It's finding the asset that you like, building a thesis behind it, so fundamental analysis, and then it's getting an entry when there is a lot of pain surrounding that asset, and then getting an exit when there is a lot of euphoria around that asset. So the first component of investing is a deeply fundamental process, building a thesis. And the second component is a deeply psychological process. So it's really about understanding yourself and understanding humans and entering and exiting at inflection points in sentiment, at inflection points of the psychological sort of game that's going on in the market. Different story for a day trader. I don't think they really care about sentiment. The sentiment flip-flops fucking the sentiment of the lower time frames is ballistic, right? The price crashes and it pumps in that same 5 minutes. Someone was really, really afraid and someone was really, really fucking euphoric, right? It's a little bit of a different game. The shorter the time frame, the less relevant sentiment analysis becomes, because it's just there's just sentiment every fucking second, because on the lower time frames, people are using leverage. Volatility is much more extreme. The emotions you feel are much more extreme as well. So the idea of the lower time frames is you focus a lot more on the technicals, and you focus a lot more on maybe order book analysis, right? Which is not so important for long-term investing. Now, obviously, you can use maybe technical analysis for long-term investing, but it's not like a really crucial component. And as well, risk is preset with trading through stop losses. So the need to limit downside is sort of pre-built into the position, right? You have a stop loss 3% below the entry. You can just leave that position and you can just wait for it to hit your take profit targets as well. You have the entry done. You've now placed a stop loss. You've now placed a take profit. All you have to do is sit and wait for either one to get hit, right? Whereas with investing, the risk isn't pre-built. And this is a problem because if you're not careful with your long-term investments, you have no stop loss, you could end up holding a minus 80% position if you never sell. And that's why long-term investing does have risks associated, because all these newbies buy the long-term coins and they go, oh, the coin will come back, it's down 30%, it'll come back, we're still in a bull run, and then it goes from minus 30% to minus 80%, and they never end up selling. So that's one advantage of trading. Risk is pre-built. It does limit your downside if you do it properly. Investing, the risk of an investment is managed much more manually. So when you manage the risk of an investment, it's before you enter, it's waiting for asymmetric upside. And then once you enter, it's analyzing the project. So is everything going according to plan? It's still, the thesis that I originally laid out is still valid. It still looks like it's going to happen. And if anything changes in the thesis, if anything changes in your belief, then you manually close the position, right? Trading, obviously, you can manually close positions, but it's much more automatic, right? So this is the caveat of gaining conviction with higher prices. Trading is a very different game, and this concept doesn't really apply, right? In trading, the price could have gone up 2x, and you can do a low time frame entry. You're only risking 2% of your portfolio, and you're playing a continuation pattern. Let's say an ascending, like a descending triangle, or a bull flag or something, right? Let's do like a drawing for you so you can see. Let's say price went up like this, then it goes sideways, some sort of a bullish flag. You buy the breakout here, you set a stop loss here, and then you have a take profit here, right? Your risk is preset. So you can obviously buy this asset, it's up 2x in a week, that's okay. The risk is fine. Long-term investing, you can't, because it's very much a different game, okay? So that's what not to do. That's all explained, and I'll see you in the next video of what not to do. Cheers.